That's why I fell for you.
All right, guys. Congratulations on getting through the semester. All done with all your classes. Exciting times. So I posted these slides, so if you want to check back on them later as you're studying, they're here on Learning Suite, as well as all the problem set solutions. If you click on any of the problem sets, the solutions are there, but I put them all here in the sort of the main dashboard and schedule page as well, to make them easier to get to. Anyway, without any further ado, let's go ahead and get started. Big picture stuff, like we've mentioned this in class, but details for the exam. It'll open tomorrow morning and be open for the duration of the finals period. So that's tomorrow through Wednesday. It will be multiple choice. I'm still finalizing the test, but I'm targeting about 60 questions. Right? All multiple choice. It will be open book in Learning Suite, but as a trade-off for making an open book, I will put a time limit on there as well. Right? So make sure you study before you start the exam, because once you start, you'll have a ticking clock. Right? So my plan is about 60 questions long and a 3-hour time limit. Right? But again, right? So I'm not going to make the questions significantly harder because it's multiple choice or because it's open book, but we will have a time limit. So make sure you study ahead of time, right? And just know going in that you're not going to have unlimited time to look things up, right? So be prepared before you take the test, just like you would if it was closed book, right? It is comprehensive. It'll be weighted towards the second half of the semester. So make sure you review things from the first half of the semester because they'll still be on there, right? But the bulk of the questions will be from the second half of the semester. Right? And in weighting, it's not just number of questions too, but also like detail, I guess. Right? So from stuff from the first half of the semester, right, I would. It's not just they'll have fewer questions covering that, but also because it's farther in the past, right, and we've already tested you on it, the nature of the questions will probably be more like higher level as opposed to more specific details. Studying, same kind of suggestions as we had for the midterm, right? Reread the lecture notes and slides, and to the extent you feel necessary, reread the actual readings. Right? But the lecture notes are good sort of cliff notes to the readings and what I feel is important and what sorts of things I'll probably ask you about. Practice the problem set questions, right? And this will be all multiple choice, right? But that doesn't mean ignore the short answer questions in the problem sets, right? Because I may ask multiple choice questions that cover concepts that were in the short answer questions as well. Examples that we have in the notes, make sure you work through those and understand those. Make sure you're familiar with the models. Right? We spent basically all our time in class on Tuesday walking through the models, and that in itself should have been a pretty good review. Right? But what we didn't do as much is draw the pictures. Right? And because it's multiple choice, I won't be asking you to draw the pictures, but I may give you some pictures and ask you about what's going to shift or change in the picture in a multiple choice question instead of having you draw it from scratch. Okay? So make sure you're familiar with the graphs and the logic of how the models work. This outline that we'll go through for the rest of the review session this morning, right? Just like what we did with the midterm, you can use that as a checklist, yes, to guide your studying, right? If you doesn't mean just read the review slides, but use this as sort of a list of concepts that you should be familiar with, right? They're not written out in as much detail on these slides that we're about to walk through as what you need to know, but it's sort of a guideline or checklist of what are the things that you do need to know and be prepared to do on the test. All right, and then again, if you have questions about any concepts, you need a little help on anything, all right, contact one of the TAs or myself, and we'll be happy to help you out. All right. So, from here on out, my plan is to just sort of walk through the concepts that we've covered throughout the semester, right? Talk about what you need to know, and answer any questions that you guys have along the way, right? So if we're, especially through the stuff from the first half of the semester, I'll move fairly quick. Just like make sure you know this, make sure you understand this, right? But as I'm going, if you have a question about a particular concept and say, this thing I don't understand, I've always been kind of fuzzy on this, and you want me to walk you through it, stop me and ask me the question, all right? Does that sound good for a format? All right, well, let's take it away then. So, first thing we started talking about this semester is output, right? And which we measure by GDP. So, it's important for you to understand and be able to answer questions along these lines of why is it that we care about output? What is it that we try to measure with GDP? Right? We think about how much goods and services we produce as an economy. Right? Why is it that we care about that and focus on that as economists? Right? Understanding how we can think of GDP equivalently as output, income, expenditure. Right? We use all those terms interchangeably. Because of the circular flow in the economy, they all are not necessarily mean the same thing, but are the same value or magnitude. Okay? So we can measure either one and we get the same number. Okay? The difference between real versus nominal GDP. Right? What do we mean by real GDP? The actual quantity of goods and services, which is ultimately what we care about. Right? What is nominal GDP in contrast?
The dollar amount, dollar value.
So the dollar value of those goods and services in current dollars. Okay? And for a snapshot in time, there's no real distinction between real and nominal, right? Because as when we're aggregating a bunch of different goods and services, the way we do it, right, to come up with a single number is, assign the dollar values of each of those goods and services. So for a single point in time, the distinction between real and nominal isn't really important. Where does the distinction between real and nominal become important? When we're thinking about changes over time, right? And when we think about the change in GDP over time, right? What gets confounded if we're looking at changes in nominal GDP? When we see a change in nominal GDP across different years, we don't know how much of that change was due to change in prices, right, or inflation, versus the actual quantity of goods and services that we care about. Right? So how do we adjust for that? Right. So we try to use a constant base year of prices, right, for the different years that we're comparing, right, and then we can get and then we sort of isolate the change that's due to quantity. And if you look at the ratio of nominal versus real GDP, we call that the GDP deflator. If you think, and changes in the deflator over time could be, it's not the primary way that we measure inflation, but it is a measure of inflation. Right? And then another important thing, right, that you guys should be very familiar with by now, right, is this idea of national income accounts identity, right? How we define different categories of spending and add them up to get total GDP. Household consumption, investment by firms, spending by the government, and net exports, exports minus imports. Okay? So again, you should be familiar with what we count in each of those income accounts. And like we said before, a general sense of how big total GDP is, what are the relative sizes between the different income accounts. Primarily, consumption is by far the biggest of these accounts. Okay, solo growth model. We'll be fairly quick with this since we spent some time thinking about it in class on Tuesday. Okay. So a couple of underlying sort of insights and assumptions for this model. One is recognizing that saving equals investment. Right? In a closed economy, everything that we save, everything we don't spend on consumption or government spending, right, gets saved, and then through the financial system it flows through firms and they spend it on investment. Right? So because of this national income accounts identity, right, this has to be true because of the circular flow of the economy, that savings equals investment. Right? And what is it that the solo growth model is there to teach us about? What are we trying to understand with this model? What determines growth in GDP, particularly GDP per capita, right, over time for an economy? Right, in the long run, what's sort of our capacity for growth? Okay, and that purpose, right, sort of guides what simplifying assumptions we make in this model. Right. So what we assume is that output depends on the productive capacity of the economy in terms of labor, capital, and technology are the three things that matter for how much goods and services we produce. Right? So at a very high level, right, changes in capital, changes in labor, changes in technology are what's going to drive changes in output or GDP. Okay? So what the solo model does for us is basically gives us a way to think in a structured way about how those changes would work and translate into GDP growth. An important element of that is this idea that there are diminishing returns to capital and labor. Which means what? What do we mean by diminishing returns? No?
I mean, we're just going to get less as we add more of just one thing.
Okay, so like the textile example we did at the beginning of the semester, you know, let's say we have 20 workers in the textile factory. If we start with 0 sewing machines, we're not going to be able to produce very much. Okay? Let's see, capital per worker, right? And output per worker. But as we add sewing machines, what does that mean for? As we add 1 sewing machine, that makes a big difference in how much we can produce. As we add a second, it also makes a difference, but not as much as the first one did, right? So you have this relationship between, once we fix the number of workers, as we add more capital to the economy, output's going to increase, our productivity is going to increase, not productivity, our production is going to increase, right? But at a diminishing rate. And then the solo model kind of builds off of that. If as we add capital in the economy, we get more output, but at a diminishing rate, okay, what does that mean for saving and investment? If we assume that we save a certain fraction of our income, right, then savings as a function of how much capital we have in the economy follows the same sort of pattern. It's just a fraction of whatever income is, right, for a given level of capital. Right? And then what is it that causes, what's the other thing that causes a change in the amount of capital in the economy? Depreciation. Okay. Right? So depreciation reduces the amount of capital. Savings and investment adds to that amount. And then depreciation takes away from capital. So, as an economy, right, we can save and invest, and that will add capital to our capital stock, right, until it gets big enough, right, that the amount of saving and investment is barely enough to cover the depreciation in each period, and then we end up in this steady state of capital per worker. Which means once we're in the steady state, what happens to GDP over time? All else equal, it stays the same, right? So just by accumulating capital, you can't sustainably grow the economy, right? But we can have growth in population, and that will grow total GDP, but not GDP per capita, because capital per income, or capital per worker, right, is going to be in a steady state. So we reach this steady state, right, and the amount that each worker can produce is going to stay the same, right? But as we grow more workers, we'll produce more stuff overall in the economy. right? The only thing that's going to cause this to change or grow over time is going to be what? Improvement in technology, right? Which allows workers to produce more stuff over time with the same amount of capital, as the capital gets better in some sense, and the workers get better through education, better processes, right, better equipment, and so forth. So the main driver of growth in living standards is going to be technological improvement over time. And with this solo growth model, again, because it's from the early part of the semester, we won't necessarily spend as much time with it. You should be familiar with the broad sort of assumptions that go into it, the main insight about capital reaching a steady state, and what are the conclusions that we come from it. And you should be able to think about, well, what happens if there's a change in the saving rate, right? Or a change in the depreciation rate, things like that. Although it probably won't be as many detailed questions about those sorts of things on the final. Money, we should be familiar with what money is, what are its key characteristics, right? Why it's important and helpful in the economy. Measures of the money supply. We talk about M1 and M2. What do those include or consist of, right? And perhaps most importantly, this idea of the three prices of money, right? We talk about interest rates, which is the price of money in terms of relative to future money. Exchange rate, which is the price or value of money relative to a foreign currency. And an inflation rate, right? How much is money worth relative to goods and services? Or how much goods and services can we buy with a given amount of money? Okay. And from there, we built up to the three-equation model. Again, we can go through this fairly quickly since we spent time reviewing it in class on Tuesday. But you should be familiar with sort of each of the elements of the model, right? It's a three-equation model, right? So there's these three main components: the demand side of the economy, which we represent with the IS curve; the supply side of the economy, which we represent with the Phillips curve, right? And we use the wage setting and price setting model of the labor market in order to motivate this relationship that we depict in the Phillips curve. And then what is it that the central bank's trying to accomplish, and how we can represent that with the monetary growth curve. Right? So you should be familiar with each of those individual pieces and what's sort of the reasoning or logic behind them, like we discussed last time in class on Tuesday. As far as aggregate demand, right? We want to understand what is it that drives the spending decisions by households, firms, and the government. Right? And the big things to take away from there is that expectations for the future are important for both households and firms. Consumption, changes in consumption spending from time to time are primarily going to be due to actual income, right? Changes in investment from period to period are primarily going to be due to changes in interest rate. And then any change in consumption spending or investment spending or government spending is going to have a multiplicative effect. And that's because of the way that consumption depends on income. So if interest rates are reduced and firms spend more on investment, that spending on investment increases income for households, so they're going to want to spend more on consumption as well, which in turn increases income even more, and has this multiplicative effect on, so that the impact on output is bigger than the direct effect of the change in firm investment spending. And the same thing is true, like if the government launches a new spending program, right, and there's an increase in government spending, the impact on overall GDP or output is going to be bigger than the direct increase of government spending, because it has this multiplicative effect throughout the rest of the economy on consumption in particular. And then we summarize all that, right, based on this idea that demand for spending has to equal actual output, right? We can only buy the stuff that there is, right? So demand for spending has to equal output, and that leads us to a relationship between output and interest rates. So a set of combinations of output and interest rates for which spending demand equals actual output. The wage setting, price setting model. Helps us motivate or understand the relationship that we ultimately capture in the Phillips curve. And with the wage setting, price setting model, right, there's two parts. And we think about the relationship between the level of employment and real wages in the economy. We have a wage setting curve that's upward sloping. What does the wage setting curve tell us?
How much firms have to pay to.
As we're employing a higher fraction of the workforce, as labor markets get tighter, right? It tells us how much do firms need to pay workers in order to motivate and retain them. And at the same time, we have a price setting curve, which tells us what? Right? How much firms can pay, and what's the limiting factor there?
Output.
How much each worker actually produces. Right? Just like we talked about with the circular flow in the economy, right? The income to households, to workers, comes from how much we produce and sell, right? Through the firms. Okay? So we can't pay workers any more than what they're producing because there's nothing to pay them with. Besides that, so you can hire more workers, right? Until we reach a point that the amount that we need to pay them, right, hits this limit of what we can pay them. And that gives us a natural or equilibrium level of employment or unemployment, depending on how you like to think about it. It's one minus employment would be unemployment. If we and then output or equilibrium output in the economy, where does that come from? How is that related to equilibrium employment? So in our three equation model, we don't look at employment directly, right? All right. So how does employment translate to output?
It gives us our equilibrium output.
Yeah, it's how much goods and services we can produce with this much employment. Okay. If we employ more people, we can produce more stuff, right? But in order to do that, the wage setting curve tells us we need to pay people more, right? But if they're not, but on a per person basis, if they're not producing anymore, we can't pay them any more than that. So when we try to raise wages, right, the firms end up having to raise prices as well in order to cover the wage increases. So we end up with rising inflation whenever employment and output is above this equilibrium level. Now, again, this wage setting, price setting model, it's in the background of the three equation model, right? It's not explicitly part of the model, it's just there to help us understand why we have this Phillips curve relationship, right? Which just tells us that when output is above equilibrium, we get rising inflation. When output is below equilibrium, we get falling inflation. And then finally, we think about what are the central bank's objectives? What is the central bank trying to do? What's their goal in terms of the model? So the way the Federal Reserve states its goals are maximum employment and stable prices. Okay. In terms of our model, how do we think about that?
At equilibrium.
We want to keep output at equilibrium, and we want to keep inflation at its target level, right? So stable at a target level. And by balancing those two goals, right, that gives us the monetary rule curve. It tells us sort of where, for any given Phillips curve, right, what is the combination of inflation and output, right, that the central bank would choose.
Question.
Yes.
So the central bank targets inflation above zero, right?
Yep.
It's usually like 2%, whatever it is.
Right.
So
why do we
that's
target
essentially
inflation
saying
above zero, by the way?
So there's a
to avoid deflation. inflation traps.
Yeah, it gives us a buffer against deflation, right? So we talked about this idea of a deflation trap, right? Where there's a negative shock to the economy, right? Output and inflation fall, right? And we may get stuck in this situation where the central bank can't lower the real interest rate far enough, right, to stimulate the economy, right? By targeting a higher than above zero rate of inflation, it gives us a buffer against that sort of outcome.
So does that mean that they are targeting employment above the equilibrium point?
No.
Well, doesn't it have to be above it to have rising inflation?
Rising inflation. Okay.
Rising
So what
inflation.
the central bank targets is inflation that's steady at and most central banks target 2% is fairly common. And that's the Federal Reserve's explicit target. So they want to keep inflation steady at 2%. Okay. If we have output above equilibrium, that means it will rise above 2% per year. Right? If we have output below equilibrium, then inflation will fall below 2% per year.
Okay, so that.
Right. So
that
what then?
model is
What
showing
this?
a change in the rates,
Yes.
not just
We're-
a change in.
Right. We're talking about the rate of inflation, not the change in prices. Okay. So it's like acceleration rather than speed. If a physics analogy is helpful, maybe not. Okay. So the way we would draw this, right, is the IS curve. Right. Gives us a relationship between the real interest rate and output. And then below, we also have a relationship between output and inflation. Which both the Phillips curve and the monetary rule curve reflect, right? So we have this target level inflation that the central bank wants to maintain, right? Say 2%. Right? It's usually positive, higher than zero, because we want to buffer against deflation. Okay? And then the monetary rule tells us for any given Phillips curve, right, what's the combination of output and inflation that the central bank would choose. So when the economy is at equilibrium with inflation on target, and there's a certain stabilizing interest rate that keeps us there, okay? And we can think about different types of shocks, okay, that can affect the economy. Right? Specifically, demand shocks versus supply shocks. We talked about. What's the difference? Okay, demand shock is a shift in the IS curve that causes actual output to move away from equilibrium output. A supply shock would be what? A change in equilibrium, right? Which causes the equilibrium output to move away from the actual output. Right? So with the demand curve, the IS curve is shifting around, right? And the bottom graph, equilibrium point stays the same. With a supply shock, right, the bottom graph is going to move around because there's a change in equilibrium, and the IS curve will stay put. Now, let's say there's a negative shock to the economy, right? What's the initial impact on output? The IS curve shifts to the left. Okay, output falls to here, and what happens to inflation? The Phillips curve tells us inflation is going to be down here. So now we have lower inflation, right? And because inflation has fallen, right, that tells us for the next period, the Phillips curve is going to shift down, because the Phillips curve is always sort of relative to whatever current inflation is and what equilibrium output is. Okay, so if inflation falls, then we're going to have a lower Phillips curve for the next period, right? And if output stays down at this level, right, inflation is going to fall even further over the next period. So what is the central bank going to want to do from here to stabilize the economy? They're going to cut interest rates, right? And how far do they want to cut interest rates? So they want to get onto the monetary rule curve. Right? The monetary rule curve tells us for any given Phillips curve, where does the central bank want to be, right? Given this monetary rule curve and this Phillips curve, the central bank wants to be here. Right? What that means is we want to get output to this level, which is above equilibrium, right? And to do that, we would need to reduce interest rates to there. And then from there, right, the Phillips curve would move up for the next period, right? So then the central bank's going to want to move to this point, which means raising interest rates back up a little bit. Okay, in order to get us to this next level of income, and we'll gradually work our way back towards this middle point where output is at equilibrium and inflation is on target. Why is it that we have to overshoot equilibrium in order to stabilize the economy?
Isn't it because they have this balance of they want to keep employment at max, so they don't want to they have to overshoot in order to not break it.
Yeah, because we have these dual goals of wanting inflation to be at target and output to be at equilibrium. Okay. And if we just got output back to equilibrium, right, inflation would stay low, right, to where it dropped to as a result of the shock. Okay. If we want to bring inflation up, we need to run the economy hot for a little while at above equilibrium in order for inflation to come back up. So we overshoot and then approach equilibrium output from the other side. Okay. And the same thing works if there's a positive shock instead. Let's see, other things. A deflation trap. What's the idea of a deflation trap? How would we represent it in here?
Interest rate is so low.
So the interest rate can't get low enough to stimulate the economy, right? Right. And what's the limit on how far the central bank can reduce the real interest rate? Okay, it's that the nominal interest rate can't go below 0, right? Because if there were negative nominal rates, people would just keep their money in cash instead of putting it in a bank or buying bonds. So if there's this limit on the nominal interest rate at 0, right, that limits how far the central bank can reduce the real interest rate, and if it's not enough to get output above equilibrium, right, then inflation is going to continue to fall, right? Output is going to continue to fall as well, and we get stuck in this downward spiral. Okay? And what do we need in order to get us out of that spiral? If we can't get there with monetary policy? Fiscal policy to try and shift the IS curve to the right enough that we can get us there the rest of the way with monetary policy. Right? And the final thing to think about, this idea of adaptive versus rational expectations. Which does our sort of basic version of the 3-equation model reflect? Adaptive expectations, which means what? In terms of how people form their expectations for inflation. Based on what inflation was last year. Does that mean, and in terms of monetary policy, that means if people's sort of expectations for inflation are rooted in what inflation was last year, then the central bank has to sort of guide people's expectations by actually forcing a change in inflation. Okay? In contrast, rational expectations, instead of being a backward-looking way of forming expectations, how does rational expectations work? Okay, so it's forward-looking. thinking about what is the Fed central bank going to do, understanding how the central bank responds to shocks, and anticipating those things in forming their expectations for inflation. So that means if the central bank can keep people's inflation expectations anchored at this target level, right, which is part of the reason why the Fed started publishing and announcing a target level of inflation, right? If they can get the public to firmly believe that inflation is always going to be around 2%, right, it becomes self-fulfilling, and people make their decisions based on that expectation. And what does that mean for the Phillips curve? What does it mean for the Phillips curve? It doesn't move, right? It just stays right here. So instead of having this downward shift in the Phillips curve when there's a shock, the Phillips curve stays where it is, right? And that means in order to in stabilizing the economy, all the central bank has to do is get output back to equilibrium. Right? Rather, they don't have to overshoot anymore. They can stabilize the economy much more easily and simply. Floor.
So is that just, they wouldn't lower interest rates in that case?
They would lower interest rates.
But not as much?
But not as much, only enough to get back to equilibrium, right? Because people are expecting inflation to be 2%, right? And in order to satisfy those expectations, the central bank has to set the interest rate to keep output at equilibrium. And as long as the public, right, has this belief about what the central bank is going to do, and the central bank fulfills that belief, right, then everything works. In practice, in real life, we're probably somewhere in between these extremes of adaptive and rational expectations, right? And part of monetary policy, right, is going to be working hard to help keep the public's expectations about inflation anchored to this 2% target level. And that helps the economy stay more stable, makes the central bank's job easier, and avoids having to makes it less costly to correct inflation. Okay, so once we got this our three-equation model out of the way to understand fluctuations in the macroeconomy, we move to thinking about the financial system. Right? So you should be familiar with, in a big picture sense, what does the financial system do? Number one job is what?
Allocate.
Yeah. So the overarching purpose is to channel funds from savers to investors. Right? So we have this circular flow in the economy, right, where savings becomes investment, right? And that happens through the financial system, right? People put their money in a bank or they buy financial assets, right? And those funds go to pay for investment. Okay? But the financial system, right, does that in a way that allocates resources towards their best uses, right? And what's sort of the feature of the financial system that helps that to happen? How do we know what the best uses are? Prices of financial assets. Right? So the firms that have the best investment opportunities, right, are going to be able to sell financial assets at the highest prices, right? And that guides where resources get allocated. So it's because of financial markets that establish prices for financial assets of various firms, right? That give us that allow the financial system to allocate resources efficiently. Okay? Right? And there's a list of other core functions that we talked about, right? And among the most important of those was facilitating risk sharing. The financial system, financial markets allow us to trade financial assets amongst each other. So rather than being exposed purely to the risk of the industry in which you work, right, the source of your own personal income, right, now you can diversify by trading financial assets, claims on income from other firms and industries, okay, all right, and we sort of insure ourselves against risk right? As a society, we make ourselves better off by sharing risk across each other, right? We talked about the distinction between direct and indirect finance. What's the difference? What is direct finance? So it's a direct interaction between savers and investors, right? Where people buy financial assets directly from the borrowers, the firms that issue them. Okay? Versus indirect finance is what?
Shadow banking?
Where it happens through banks or intermediaries. Okay? Right? Which may include shadow banks. Right? Or sort of institutions that serve as intermediaries but are not actual banks. Right?
So basically, like, I go to that person and then say, can you lend me money? That's direct.
That would be direct.
Whereas if I go to a bank,
If you put your money in the bank and the bank lends to somebody and the bank makes a loan to somebody, that's indirect finance. All right. So we talked about some of the different types of financial instruments. Debt versus equity versus derivatives are kind of the three big categories. Right? So you should be familiar with the differences among those. Asymmetric information is an important sort of problem or feature in financial markets. Right? Whenever you want to lend money to somebody, you face these problems of adverse selection and moral hazard. What's the moral hazard problem when you're lending money to someone? Okay.
not their money.
Right. Yeah, so they may use the money in ways that you wouldn't want them to, right? That negatively impact their ability to pay you back, right? And you can't perfectly observe or control what they do. You can't tell whether a bad outcome is because they made bad choices or because they just had bad luck, right? And that allows people to, take on more risk than you would like it to when you lend them money, right? What about adverse selection, right? What's the basic idea of adverse selection when you're lending someone money? It's hard to tell the difference between the good borrowers and the bad borrowers, right? And when you offer to lend money at a certain interest rate, right? It's only the borrowers that are worse than the risk that interest rate would compensate for that are willing to take that loan, right? So that these two, types of information problems that can hamper the functioning of financial markets. How is it that banks and other intermediaries help resolve those problems? Yeah, so they specialize in monitoring and screening, right? So so banks can do a better job of identifying and distinguishing between the good credit risks and the bad credit risks, right? To help overcome the adverse selection problem. They also monitor borrowers, right? Better than individual savers could do, right? And to help alleviate the moral hazard problems that are inherent in lending. A couple other things with basic financial market stuff. Asset prices is basic principles of what determines an asset price and changes in asset prices, right? When you think about any asset price, whether it's a stock or a bond, what's the general idea of how we decide, how do we calculate how much it's worth?
The rate.
It's a present value, it's the discounted cash flows, right? Present value of expected cash flows from that financial asset. Right? So when you think about what causes asset prices to go up or down, it could either be a change in expected cash flows or a change in the discount rate, right? Or interest rates, or riskiness of those cash flows. Okay? And related to that, these ideas of asset bubbles and crashes that we talked about, that you can have these episodes where people start making their decisions about expected changes in prices rather than the actual fundamental expectations of cash flows and discount rates. Right? And that can lead to these self-fulfilling bubbles that eventually pop. And finally, some kind of thoughts about bond yields and the yield curve. This basic relationship between prices and yields. What's the relationship? When prices go up, yields go down, and vice versa. Right? So think of yield as the rate of return on a bond, price is the present value, right? If for a given set of cash flows, if you pay a higher price, you're going to earn a lower return, right? And vice versa. So there's this inverse relationship between prices and yields. Should be able to think about supply and demand for bonds. How does that impact prices and yields? What are the sorts of things that can change the demand or the supply for bonds? When we compare yields across different bonds, we should be able to interpret those differences. So think about like credit spreads and term spreads for the same borrower with a short-term bond versus a long-term bond, right? How do we understand what the difference in yields between the short-term bond and the long-term bond represent? Why would we call it a term spread because the difference in yields is coming from the difference in the terms of the loan, right? Like the duration, right? Why does a longer term bond tend to be have higher yields than a short term bond?
Because you're subject to the risk for a longer period of time.
Okay, right. So changes in interest rates are going to have a bigger effect on the long term bonds than short term bonds because you're compounding that change over a longer period of time. Right?
Would risk associated with the term length, would that be both interest rate risk and inflation risk, or just interest rate risk? Or would it be all three of them? I mean, I can see.
So inflation risk and interest rate risk are both going to be a part of that, right? So it's sort of semantics to some sense. When you're thinking about interest rates, if you're thinking in terms of nominal interest rates, which we normally do, the nominal interest rate includes the real interest rate and expected inflation, right? So changes in the nominal interest rate is going to cover like both changes in real interest rates and changes in inflation, right? If you want to distinguish between the two, you'd have to think in terms of real interest rates versus inflation, both of which are included in the nominal interest rate. Michael?
So, I'm curious, if you're talking like a corporate bond versus the treasury bond.
Okay, corporate versus treasury.
Of the same term, that's the default risk.
That's what we would call a credit spread or a default spread.
The question is more, if you take a corporate bond and have like a 1-year corporate bond or a 10-year corporate bond in the same company.
Yeah.
Why isn't default risk also a part of that? Is there a kind of a?
So it could potentially be. Right. So you could think of when we talk about a term structure of interest rates, where you know, what's the relationship between the term and the market discount rate that investors require, right? And who tend to require longer, higher risk premiums for longer term interest rates because there's more uncertainty about changes, and longer term bonds are more sensitive to those changes in interest rate, right? It's not something we talked about, but you can certainly think about a term structure in credit risk, right? Like over a short term, right? There may not be much risk that a borrower defaults, but over a longer term, maybe the risk is higher. So there can certainly be a term structure of credit risk as well that could lead to a relationship between default risk, right? To keep things simple in this class, we're sort of making a distinction where if you're comparing like comparable bonds with different terms or maturities, right? Otherwise comparable bonds, then the difference is primarily due to differences in their sensitivity to interest rate and inflation risk. Right? Whereas if you take two like 10-year bonds, one's a corporate bond and one's a treasury bond, both at the same coupon rate, the promised cash flows are exactly the same, right? If there's a difference in their yields, what does that difference represent? Differences in default risk. That's basically it when you think about interpreting bond yields and comparing across bonds, right? And then the final thing is thinking about the yield curve, right? And what does it mean? So when we think about a long-term interest rate, what's the relationship between long-term interest rates and short-term interest rates? There's this arbitrage-based relationship that that should hold, right? If we have, you think about what the current short-term interest rate is and what the short-term interest rate will be in the future, right? Right? The long-term interest rate, like if we knew with certainty what the future short-term interest rates would be, then the long-term interest rate would have to be the average of the current short-term rate and what the future short-term rates are going to be, right, over the period of the long term. Right, does that? There's not a lot of. I'm going to go ahead and erase this.
Oh, snap.
If I can reach it.
Oh.
Stayed in the walls. They're okay. Okay, so think over time, right? So we have the current short-term interest rate and what the future short-term interest rate is going to be for these future one-year periods. Okay, so the spot rate, the one-year spot rate today, right, and what we think the spot rate is going to be next year for 1 year, and what the current 2-year spot rate is today, there has to be a relationship between those, or else it creates an arbitrage opportunity. Right? At least if we knew what this future interest rate was going to be. Okay? And this 2-year spot rate would have to be the average between what the 1-year spot rate is today and what the 1-year spot rate is going to be next year. Okay? So if this is 3% and this is 5%, right, this would have to be 4%, the average of these two. Okay? And if we know what this interest rate is going to be, right, then that's something that would have to hold, or else there's an arbitrage opportunity. If we don't know for sure what this is going to be, if there's risk about it, right, then it's not quite an arbitrage opportunity anymore, and there's a risk premium that investors are going to build in order to hold the longer-term bond, because they don't know what this is going to be. Right? So this would be 4% plus a risk premium, so it might be something like 5%.
Remember you talked about how the 1-year term should all be equal if they were to arbitrage shall drive them all to the same rate.
Not necessarily off the same rate, right? But this would have to exactly equal the average of those two, right? So if we know that this here's that the current 1-year rate is 3%, and if we know that next year, see the Federal Reserve is going to raise interest rates by 2%, and it'll be 5%, right? If we're certain that's going to happen, right, then the 2-year interest rate today should be 4%. If not, there's an arbitrage. You could trade to take advantage of that difference. Okay? And that trading would drive that interest rate to be equal to the average of those two. Okay? The fact that we don't know for sure what that's going to be, right, means that this interest rate is going to equal the average of what we know the short-term interest rate is today and what we think it's going to be in the future, plus some risk premium. Okay? So that means on average, when we think about, if we draw a picture of the yield curve, which is time to maturity, right, and yields on the y-axis, okay, on average, the yield curve slopes up, because even if we thought interest rates were going to be the same, we're going to stay about the same going into the future, because of the uncertainty about interest rates in the future, right, these long-term interest rates will be higher because of those built-in risk premiums. Okay. So, like a normal yield curve where we expect interest rates, short-term interest rates to stay about the same going into the future will be moderately upward sloping. A steeply upward sloping yield curve would reflect what?
There's like a real
We're expecting short-term interest rates to be higher in the future, right? In order for the yield curve to be steeper than normal, right? If the yield curve were flat or even negative, what would what would that reflect?
Increasing short-term.
Right, well, these interest rates are going to be going down in the future. Okay, even if it's flat, right, because of the risk premiums that are built in there, that would have to reflect an expectation for lower interest rates in the future, right? And then the risk premiums are sort of bringing it up to be flat, right? And if it's negative, that's a pretty strong expectation that interest rates are going to be lower in the future, right? And what does a negatively sloped yield curve, a downward sloping yield curve, tend to predict? Recessions, right? And you think about why that's the case, right? What is when there's a recession, right? How does the central bank respond? By lowering interest rates. Okay? So a downward sloping yield curve means that people are expecting a recession, expecting the central bank to respond with lower interest rates, right? And that gives us a downward sloping yield curve, right? So the downward sloping yield curve doesn't cause the recession, right? It just reflects everybody's expectations that there's going to be a recession in the near future. Okay. So that was the first half of the semester. Let's move on to think about the second half of the semester. We started thinking about banking. Okay. So as a starting point, you should understand what are the roles that banks play in the financial system. Okay. A primary reason that we said why banks exist, right? So they're part of the system for channeling funds from savers to investors, and they do so in a way that helps resolve information problems. Right? Banks specialize in screening and monitoring borrowers, right? In a way that's hard to do with direct finance and small individual savers, right? So they pool, and part of that comes from pooling together the deposits of savers and the incentives that it concentrates in the banks, right? So they pool together small savers and make big loans, right? And that concentrates their incentives to be careful about selecting who they're going to lend to and paying attention to those borrowers as they're paying back their loans. They also facilitate risk sharing, right? So by pooling together the savings of a bunch of individual savers and investing in a bunch of different loans, there's this built-in diversification for the depositors that banks are providing. They also provide intertemporal risk in the sense of providing a way for people to both save their excess funds and borrow when they have a deficit of funds, right? They help people manage like shortfalls or surpluses of income in any given period. And then what we spend a fair amount of time thinking about is that banks serve as intermediaries in the sense that they resolve the mismatch between savers that want short-term, safe, liquid assets to invest in, and borrowers who want to invest for longer-term, risky projects. That's a fundamental mismatch between the savers that supply that ultimately supply the funds versus the borrowers that want to use those funds for investment. And banks intermediate between the savers and borrowers and help resolve that mismatch. And we depending on what we're focusing on, whether we're focusing on the difference in the term or time frame, right, of deposits versus loans, we would call that maturity transformation. If we're focusing on the riskiness of deposits versus loans, we would call that credit transformation. If we're focusing on the liquidity of deposits versus loans, we would call that liquidity transformation, right? All of those are a function, are sort of a function or a role that banks provide by intermediating between savers and investors, right? And resolving the mismatch between the needs of savers and the needs of investors. And other things you can think about that banks provide, the payment system works through banks, safekeeping and accounting services and so forth. Right? You should be familiar with the major components of a bank's balance sheet. Okay? So you think about a balance sheet of the bank, and it's reverse of a normal non-financial firm's balance sheet in what sense? Loans are assets rather than liabilities, and deposits are liabilities rather than assets. okay? Because banks are on the other side of those transactions. So for a bank, what is the primary form of liabilities for a bank? Deposits. What are the other sources of funds? Borrowings. From the money market. So like the Fed funds market, repo markets, and so forth. And they could potentially borrow from the Fed if they need to. Okay. What are the primary assets of a bank? Loans. And some of those deposits they have to keep in what form? And what else do banks sometimes hold? Securities. Okay. So, and you should also be able to think about the examples in that set of notes or slides, right? What happens when a bank gets a deposit? How does that change the bank's balance sheet? So if somebody deposits money in the bank, say $100 of deposits, what does that mean on the asset side? The immediate impact is they add $100 of reserves. Okay? And then from there, it depends on what they do with that money. Right? Are they going to want to just keep it as reserves? Why not? Because they don't get a return, or they only get the interest. Nowadays, they get the interest rate on excess reserves, right? And the Fed pays, right? But traditionally, we think of this zero return on reserves, but they do have to generally pay an interest rate on deposits, right? So they want to do something with money that generates a return, so they can make money, which would be what? Either loaning it out or investing it in securities, right? But primarily loaning it out. So that's what we think of as the traditional role of banks. They take deposits and make loans. Okay. Now, by loaning out some of those reserves, right? What risk or problem does that create? So it creates a default risk, right? If it's just sitting in reserves, right? If we switch to say, if we invest 90 of those dollars in loans, okay, now we have credit risk, right? Because there's a possibility that those loans default, right? And the assets lose value relative to the liabilities. Okay? So credit risk is something that banks assume by lending out some of those deposits. Right? What other risks do banks assume? Liquidity risk. Right? So what happens if depositors come and want to pull out more than $10 worth of reserves? You're gonna have to do something to come up with that cash. Either borrow money or sell off some of your assets. Right? What other risk gets introduced by converting some of these reserves into loans or securities? What's sort of the duration of deposits? They're very short term. I mean, people can leave them in there indefinitely, but they're like a very short-term loan in the sense that people can pull it out whenever they want, right? So, I mean, the closest equivalent we could think of is a very short-term loan that gets rolled over indefinitely, okay? But they're very short-term versus loans, which would be longer-term, right? What other sorts of risk does that introduce for banks? Right, a maturity risk or an interest rate risk, right? And how does that create? So what's the risk there? If interest rates go up, for example, what does that do to the value of their loans? The value of the loans falls. What about the value of the deposits? There's not much of a difference to the
It's short term.
I mean, it would still go down, but not very much. Okay, so deposits, because they're so short term, aren't very sensitive to changes in interest rates, right? But loans are. Okay? the present value of loans of it. Okay? So there's these three main types of risks that banks take on by taking those deposits and converting them into loans. Right? Now, so there's this tension, right, between when banks want to, banks don't want to just leave the money as reserves, right, because then they would be losing money, right? So they want to lend out as much as they can, right? But there's this tension between generating profits by converting those reserves into return-generating assets, like loans, right? Versus maintaining enough reserves to keep liquidity risk manageable. Right? Now, traditionally, we've thought of banks as just wanting to lend out as much as they can, right? And what do regulators impose in order to limit that? Reserve requirements. So the Federal Reserve sets a reserve requirement, say you have to keep at least 10% of deposits on loans, right? Nowadays, the way banks perceive this trade-off is a little bit different, and banks are keeping lots of excess reserves, right? Because both because the central bank is paying interest to incentivize them to do that, right? And also because banks are putting more weight on safety, right? Rather than purely maximizing profitability without regard to safety. The other aspect of a bank's balance sheet that relates to safety is their capital. Right? What does capital do for a bank?
Allows them to absorb losses.
Allows them to absorb losses. Right? So changes in interest rates that have a differential impact on assets versus liabilities, right? Or losses due to default, both of which are going to shrink assets, right? Relative to liabilities, and it's going to reduce bank capital. So bank capital gives them a cushion in order to absorb that. But again, by having more capital, right, what does that mean for the profitability of banks? Or the returns to their shareholders? It's not as good. Returns to shareholders are higher when capital is smaller and leverage is higher, right? So on one hand, there's this incentive for banks to increase leverage and expand their balance sheet relative to the shareholders' capital, right? But on the other hand, right, the more they do that, the riskier banks are, and the higher the risk the bank becomes insolvent and fails if there's a loss of value on the asset side. Okay? So government regulators also impose capital requirements, right, that limit the amount of leverage that banks can take. And again, banks' attitudes towards leverage have also changed
So when you
since
say
the
that-
financial crisis.
Can you say that the returns are higher when leverage is higher?
Uh-huh.
Do you mean like when deposits are, when you have more deposits versus loans? Or like what do you mean by that? Like how is there leverage higher?
Well, it's just the relationship between return on assets and return on equity, right? The more leverage you have, the higher the return on equity relative to your return on assets. That's something you guys knew before this class, right? Okay, and it's true for banks just like it would be for any other for any other firm, right? So for a given amount of equity, banks are going to want to expand their balance sheet relative to the amount of equity they have, right? As much as is reasonable, right, within the limits of the risk they're willing to bear, or what financial regulations will allow, right, in order to maximize the return on equity, right, given the return that they get on their assets. Does that make sense? Okay, so we've already hit on some of these a little bit. That as intermediaries, right, by intermediating between savers who want short-term, safe, liquid investments, and borrowers who want to borrow to fund longer-term, riskier projects, right? Banks take on interest rate risk, right, by having longer-term assets relative to their liabilities. They take on credit risk by having risky loans as assets, right, with very safe liabilities to their depositors. And they take on liquidity risk by holding relatively illiquid loans while offering very liquid deposits to savers. Okay? So you need to be able to think about, right, the nature of those risks and how is it that banks try to manage those. Right? So we already talked a little bit about what happens when there's a change in interest rates, at least in terms of asset values and liability values. Right? When interest rates rise, right, the asset side of the balance sheet is gonna reduce in value by more than the liabilities. So it's gonna be so it's gonna hit their capital. Right? But we also talked about how there's another effect that it has on banks when interest rates rise. How does it affect their profitability, right, period by period, as opposed to the values on their balance sheet? If interest rates rise, profitability goes up, right? Because they now can start lending out money at higher interest rates relative to what they pay their depositors.
So you said when interest rates go up, the asset side is hit more than their liability side.
So we looked at a couple of articles that talked about this. As it, in the past couple of months, as interest rates are rising, right? On the one hand, it's causing a hit to the values of securities on banks' balance sheets, right? But on the other hand, it's increasing bank profitability because now as they're making new loans, right, they're doing so at higher interest rates, right, relative to what they're paying on deposits.
Can you go over real quick why the assets decrease more than the liabilities values?
It's purely because they're longer term, right? So deposits, so banks' liabilities are short term, whether they're deposits or short term borrowing in the money markets, right?
Yep, we're good.
So their present values are relatively insensitive to changes in interest rates, whereas their longer term assets are more sensitive to changes in interest rates, right? They both go down, but the asset side goes down by more because they're longer term. And what's the primary way that banks can try to manage interest rate risk? Interest rate swaps, right? So what does an interest rate swap do? Yeah, so what do you swap in an interest rate swap? Okay, a fixed rate for a floating rate. Okay, so for a given amount of principal underlying the interest rate swap, one party makes fixed payments, payments at a fixed interest rate on that principal amount, right? And the other party makes interest payments on that same principal amount, but the interest rate which they pay is going to fluctuate with market rates, right? So one side pays fixed, one side pays floating, right? Now, when you think about a bank, what's the nature of their cash flows? Are they fixed? Right? Do they tend to be fixed or floating? Right? So when the bank makes a loan, does the payment that you make, like if you borrow money from the bank, do your payments usually change when interest rates change? No, you usually have a fixed set of payments. Right? So most of the assets on the bank's balance sheet, right, generate a fixed stream of cash flows. Right? So when interest rates change, what happens to the present value of those cash flows? Yeah, if interest rates rise, the present value goes down. So the present value is sensitive to interest rate changes, right? What if you had a floating stream of cash flows where this magnitude of the cash flow changes with interest rates? Right? When interest rates change, what happens to the present value of that stream of floating interest payments?
It stays the same.
It stays the same, right? Because the magnitude of the payment will go up, but the discount rate goes up at the same time, so the present value stays the same. So with an interest rate swap, what banks can do, all right, is essentially by taking the fixed payer side of an interest rate swap, right, they can take this fixed income that they're getting from their assets, right, and pay it into the interest rate swap, and in return they receive floating income, floating payments in return, and that reduces their sensitivity to interest rates so that they can equalize the interest rate sensitivity of the asset side and the liability side. What about credit risk? Okay. So credit risk banks take on by making loans instead of just keeping their cash as reserves. Right? We talked about some of the various ways that banks try to minimize credit risk. Right? One is the basic function that banks perform of screening and monitoring. By doing a good job of that, they limit the credit risk that they bear. Right? Having long-term relationships with clients, how does that help?
does it help adverse or not?
Yeah, it helps with adverse selection. It helps them have a better sense of what the credit risk of their clients are, right? Because they've worked with them for a long time. Okay. Diversification, right? By making loans to lots of different borrowers, right? They're more diversified against defaults than any one borrower. Securitization also helps them manage credit risk, right? By instead of keeping those loans on their balance sheet, right? They sell them, right, and replace them with securities that are backed by a diversified portfolio of different loans or debts. Okay. And then credit derivatives, they can protect against an individual borrower, against default by an individual borrower with a credit default swap, for example, or they could also get protection against sort of a wave of defaults by using an index of credit default swaps. Right? And then securitization also creates these a form of credit derivatives, like credit like CDOs or mortgage-backed securities we can think of. In some sense, those are credit derivatives. Okay. But all of those are ways that banks can try to mitigate or manage the credit risk that they take on, right, by performing their primary function. Okay. And in terms of liquidity risk, right, we thought about liquidity risk in terms of the Diamond-Dybvig model. Right, which we spent some time thinking about and reviewing in class on Tuesday, so we can go through this fairly quickly. Right, but the main insights that we get from this model, right, when we think about why is it that savers value liquidity? Why do savers want to keep their savings in liquid assets rather than illiquid assets? Floor?
They don't know when they're going to need money.
Yeah, so there's uncertainty about when they're going to need their money. Right? To the extent that they have uncertain spending needs, they're going to want to keep their assets or they want to keep their savings in liquid assets. Right? On the flip side, when borrowers want to borrow funds, right, they tend to be longer term, riskier assets, and when you make loans, those loans are fundamentally illiquid. Right? And why is that the case? It's like two big reasons why when you lend money to someone, it's hard to get your money back without a loss of value.
Because that's the whole reason why they're getting a loan is because they don't have it.
Okay. They may not have the money to pay you back yet because they've invested in a project that's going to take a while to generate returns. Okay. And they didn't have money, and that's why they borrowed it in the first place. Okay. So they may not be able to pay you back if you try to get your money back early. Right? What's the other way you could try to get your money out of a loan besides just asking for it back early?
You can try to sell it.
You can try to sell it, but why is it hard to sell a loan for its full value? Yeah, there's this information asymmetry between you as the original lender versus anybody who might buy that loan from you. Right? You know more about the quality of the borrower, right? They don't know whether you just need to get your money out because you have some expense that you have to pay for, versus if you found something out about that loan, right, that it's worse than you thought and you're trying to dump it. And because they don't know, they're going to assume that you have bad information about the loan, right, and they're going to discount the price that they're willing to pay. So how is it that banks resolve this mismatch between the needs of savers and borrowers?
Spread.
What's that?
Spread between the borrowing rate and the lending rate.
Okay, so there is a spread, right? But what is it that banks? So savers want liquidity, loans are fundamentally illiquid, right? How is it that banks solve this problem?
By combining all of the
Okay,
loans.
by pooling together lots of deposits, right?
Depositor share.
So it creates this risk sharing where the depositors that don't need to pull their money out essentially cross-subsidize the depositors that do need to pull their money out, right? So there's going to be some costs whenever the bank needs to liquidate assets to meet withdrawals, right? And those costs are kind of cross-subsidized by the borrowers that don't need to pull their money out early, right? That allows the bank to create these deposit contracts that are more liquid than the underlying loans. Okay. But then there's this issue, right, that depositors can choose when they want to pull their money out, whether they have a genuine liquidity need or not. Okay? Now, we wouldn't have this problem if banks could verify, right, whether borrowers legitimately needed to pull out their money or not. Okay? If banks had a way of getting verification from borrowers, like, do you really need your money now, right, or not, right? Then they could restrict withdrawals to the people that really need it, and we wouldn't have this problem, right? But that's really hard to do in practice, right? So we have to design deposits in a way that depositors are allowed to pull their money out whenever they want, and because they're allowed to pull their money out whenever they want, right? We have this fragile equilibrium with the banks, right? Where there's these two possible outcomes, and what are the two possible outcomes? The people that can leave their their funds in the bank do so, and everything works like it should, or everybody tries to pull their money out early, and we have a bank run, and the bank fails. So you should be familiar with these two possible outcomes and understand why, right? It's a rational decision in both cases by the depositors, right? Depending on what they think other depositors are going to do. Now, once we sort of establish this idea of a classic bank run, right? We started thinking about some of the developments in the modern financial system that have led to sort of a different type of run, right? That has the same effect on the as far as the banks are concerned, right? But is a little bit different in nature, right? And a big part of the reason why that arose is through the development of what we call securitized banking and the shadow banking system. So you should understand, like, what are the factors that motivated this shift towards securitized banking, right? And what are the key differences between the traditional model of banking and the securitized model? And what are the big differences?
Instead of generating loans and holding them, they generate
Okay.
loans.
So in holding on to the loans, we sell them. The originators of the loans sell those loans. Right? The main source of funding, right? Instead of being primarily funded by deposits, right? What became an important source of funding in this securitized banking system? Short-term money market borrowing, particularly repo. Okay. And there's this difference in sort of short versus long intermediary chains, or intermediation chains, right? So traditionally, it would just be a bank that would take deposits and make loans, right? So there's only one entity in that chain between savers and borrowers, right? With securitized banking, as the rise of securitization occurred, you had this development of specialization in each of the different steps in the securitization process, where you would have one entity that would originate the loans, right? And they would sell those loans to a warehouser, right? Who would accumulate loans until there's enough to sell them to a securitizer, who would bundle those loans and issue mortgage-backed securities, right? And the other institutions that would buy those securities and hold those and use them as collateral to make loans and raise additional assets, right? And so forth. So you end up with this long intermediation chain, right? And many of the institutions that were involved at each step of that process, right, were not necessarily banks. And to the extent that non-bank institutions, keep getting these like dance students, I think, coming in here and having no idea what's going on. It's like she was in the class, I think. We had another that came in earlier. Anyway, it's fine. All right. So one of the issues with this rise of the securitized banking system is you have institutions that in each step of the process that are performing bank-like functions, right? In the sense that they're doing liquidity transformation, but they're not banks. Okay? So in what sense, let's say a loan warehouser, for example, right? So they buy loans from the originators and accumulate loans and eventually sell them off to a securitizer, right? In what way are they performing liquidity transformation and maturity transformation and credit transformation the way a bank normally would? What assets are they holding and how are they funding those assets? What types of assets does a loan warehouser hold? They hold the loans, which are long-term, risky, illiquid assets, right? And how are they funding those loans for the period of time that they hold them before they sell them off to a securitizer? They fund them from the money market, right? So they use short-term, liquid, safe forms of funds. So they're performing the same types of transformation that a bank is doing, but they're not a bank, and they're not subject to the same regulation or safeguards that banks have. Okay? So we refer to these institutions that are performing bank-like transformation, bank-like functions, right? But are not actual banks, and are not regulated by banks, and don't have the same access to the government backstop, right? That banks have. We refer to those as shadow banks. Right? Now, this system gave rise to a different type of run, right? Which we called a run on repo, right? And we thought about how does this run on repo differ from a classic bank run like the Diamond Dipvig model describes. From the bank's perspective, in both cases, it's a loss of funding, right? But how is it different when it's a run on repo versus depositors rushing to pull out their funds?
Because the loans were bad, people didn't pay back their loans.
So it's not about the loans, right? It's about the funding. Right?
As repo lenders see that banks are being more risky, the assets they're putting up for collateral more risky, they're demanding a larger haircut, and so these banks have to put up more assets, or in order to meet their capital requirements, they have to de-lever by selling assets, which creates a downward spiral in prices.
Yeah, so the way in which they pull back their funding is by raising haircuts, right? Or refusing certain forms of collateral on a repo loan. But these money market lenders, right? Just like a bank, they have assets, right? Which are their loans that they've made to banks and like the institutions that are participating in this securitized banking system, right? And they have their own liabilities. So let's say this is like a money market mutual fund, right? That gets deposits, essentially deposits from savers, right? And they invest by making repo loans to an institution that's involved in the securitization system. Okay. Now, let's say one bank fails and can't pay back their loans, and this lender takes some losses. Okay. The value of their assets shrinks, and so does the value of their equity. Right. So now they have higher leverage than they want to have, and what are they going to have to do? They're going to have to de-lever. Okay. So in order to get back to an acceptable amount of leverage, they're going to have to reduce their get rid of some liabilities and assets, and that means reducing the amount that they're willing to lend out in repo, in the money markets. Okay, so you end up with this general pullback, right? As the institutions that are serving as lenders in the money market start to experience some losses, they're forced to delever, and they're not providing as much funding anymore, right? And that means a loss of funding for the banks that were depending on these short-term sources of funds, right? And as far as the banks are concerned, right, the banks and shadow banks are concerned, right? As the money market lenders pull back on their lending, in order to delever, right? That's a loss of funding, a loss of an important source of funding for banks, and it has the same effect as depositors pulling out their funds in a traditional bank. Okay, but it's different in the sense that it may not have anything to do with this specific bank. Like when depositors run on their bank, it's because they're concerned about the solvency of the bank itself, right? And that prompts them to rush to pull out their money. When with this type of run on repo, right? There's this contagion across the financial system, right? Because even if the losses by a lender were unrelated to a particular borrower, right? That borrower is going to face a shortage of funding because there's this general pullback by lenders. And that's something that's sort of different and unique about this market-based funding system and the shadow banking system, right? Where these institutions were borrowing primarily from the money markets rather than depositors, right? So they became sensitive to this type of general pullback by money market lenders, right? Which has the same effect, but is different in sort of its nature and motivation, right? Than a classic bank run. Okay, so having understood how banks work, right, and that banks, because of the nature of this liquidity transformation and credit and maturity transformation that they provide, right, they're fragile and subject to runs, right? Whether it's a classic Diamond Dybvig style bank run or a more modern like run on repo, right? They're subject to shortfalls of liquidity, right? They face this liquidity risk and they're subject to runs. So how is it that we try to resolve this and prevent bank runs? What are the main two tools that the government provides?
FDIC.
Okay, so government deposit insurance, the FDIC, and then the Federal Reserve serves as the lender of last resort, so banks can borrow from the Fed if they have a shortfall in liquidity, right? So what are some of the reasons why these might not work the way they should, right? In principle, these should prevent bank runs, but why might they not? So banks may be reluctant to take advantage of the lender of last resort because it sends a bad signal, right? And the Northern Rock situation is a prominent example of that.
The Fed requires good collateral, and you're going to them, it's likely that your collateral is not good, so they won't lend to you.
Right? What else?
Moral hazard issues, if there's like a backstop there, or a safety net, then they'll take on more risk.
Right. So banks take on more risk and end up being just as risky and prone to runs because they take on excessive risk, right? Because of the safety net that's provided by the government. Okay. What else? What about deposit insurance? Are there any sort of limitations or reasons why deposit insurance may not fully work?
It's only up to a certain amount, so.
Right, it's up to limited amounts. So people with institutions or firms with large accounts may want to maybe have sort of incentives to pull their money out even when there's deposit insurance. Okay. And another big reason, right, with the rise of the shadow banking system, right, so a lot of the institutions that were performing bank-like functions and subject to the same types of liquidity risks that banks are, and prone to runs in the same way that banks are, even though they're not actual banks, don't have access to these government safety nets, right? So you can still have a financial crisis and financial institution failures, right? Because a lot of the institutions, right, that were performing bank-like functions were not actually banks and didn't have access to these. So the presence of this government backstop means that banks have incentives to take on excess risk, right? So now we have to solve that problem, right? So we try to prevent bank runs with government deposit insurance, lender of last resort, but now banks take on more risks than they should. So how do we try to solve that problem? with regulation, right? With regulation in general to try to limit risk-taking by banks, right? So we talked about a couple of things in relation to regulation that you should be familiar with. One, right, why is it that we regulate banks and worry about banks more than other industries?
Essentially because, well, they kind of hold up the entire financial system, and voters, you know, all of us are, you know, we rely on bank security for our own fund security and our investing. So it's like it's politically beneficial for politicians to target banks because if we're not happy, they don't get reelected.
Yeah. So for a non-financial firm, if a non-financial firm fails, right, it generally doesn't have a lot of like spillover effects into the rest of the economy. Right? They just fail, you liquidate their assets, or some other firm takes buys their assets and assumes their assets, and then you go through bankruptcy and move on with life, right? But how are banks different?
Spillover.
What do we call it? And what is the sort of the econ word that we use for these types of spillovers? Externalities, right? Meaning that the banks have incentives. The banks don't internalize the impact that they have on the other banks and on the economy as a whole when they're making their risk-taking decisions, right? So they tend to take on more risk. So from the bank's individual perspective, like the amount of risk that it makes sense for them to take is higher than what, as a society, we would like the level of risk-taking we would like banks to do, because banks have a big impact on the rest of the banking system and on the economy as a whole, right? So that negative impact of a bank failure is bigger than the impact to the individual bank, right? So there's this mismatch in incentives, right? And we refer to that as an externality. So we talked about a couple of the different ways in which banks have negative externalities, both on other banks and on the economy, right? For one thing, because banks are interconnected and lend to each other, when one bank experiences losses, they have to pull back, and it's a loss of funding to other financial institutions, and you can have this chain reaction of failure, like we saw in the financial crisis. And another important reason, like you mentioned, is that banks lend to the rest of the economy. The rest of the economy depends on banks for funding, right? And when banks fail, it disrupts that flow of funds from savers to investors. Okay, and we had a slide with a whole list of different types of externalities, but they're all basic variations on those basic two ideas. Okay. We also talked about a distinction between microprudential and macroprudential approaches to regulation. What do we mean by those? When we say microprudential, well, first of all, when we say prudential, what does that mean? We want banks to behave in a prudential way.
Responsible.
In a responsible way with reasonable, risk-taking, right? So when we say microprudential, what's the focus? On individual banks, right? Limiting their risk-taking and making sure individual banks are making good decisions. What do we mean by macroprudential regulation? Just to focus on the safety of the banking system as a whole, right? So that would mean things like differential capital requirements for big systemically important banks versus small banks that are not as interconnected, right? And maybe altering rules or changes across the business cycle. Things like that you could think of as macroprudential approaches to regulation, as opposed to just rules for individual banks. Okay. And finally, you should be familiar with the major provisions of Dodd-Frank. Right? What are the main things that Dodd-Frank does? What are the strengths and weaknesses of that legislation that you're reading in the slides talked about? Now, having talked about banks and the possibility of bank runs and disruptions in the financial system, right? We talked about how can we incorporate that into our understanding of the macroeconomy. So the three-equation model, as we originally developed in class, doesn't really have a place for the financial system, and yet, right, as we studied banks and talked about the financial crisis, it's clear that the financial system is pretty important for the economy, So how can we capture that in our 3-equation model, right? And what's the main way we do that? We introduce a spread, right? Recognize that there's a difference between the interest rate at which banks can get funds from savers and the banks and the rate at which banks will lend fund to borrowers. Okay? And then by introducing that spread, right, we recognize that the central bank can sort of set the bottom of the spread, but where the top of the spread is that matters for the economy is ultimately determined by what's going on in the banking system. Okay? So the Federal Reserve can indirectly influence the economy by setting the federal funds rate, but the actual impact of the economy has to flow through banks, and conditions in the banking system are gonna be important. Okay? So that and we can think of this, the magnitude of that spread as reflecting conditions in the banking system. When credit markets seize up, that spread's going to get wide. When there's ample credit and things are going well, that spread is going to be small, right? And so changes in the spreads can sort of independently impact the economy, right? And they also have an impact or implications for how the Federal Reserve sets its interest rate in an attempt to impact the economy, right? So these changes in the credit spread in and of themselves can be shocks to the economy, right? And as the spread changes, right, while the Federal Reserve is trying to change the bottom interest rate, that can frustrate the Federal Reserve's attempts to stabilize the economy. So once we had thought about that a little more, we spent some time thinking about the financial crisis and thinking about monetary policy in response to the financial crisis, and how are we going to do monetary policy now that we're out of the crisis but have a really big Federal Reserve balance sheet. Okay. So in analyzing the crisis itself, we focused on leverage cycles, okay, these feedback loops between asset prices and balance sheets. Okay. And what's the basic idea there? In the upswing of a financial crisis, or in the upswing of this leverage cycle, what's happening? Asset prices rise, right? Asset prices rise. That increases capital, right? So banks can increase their balance. It gives bank room to increase their balance sheet, right? But what does that do to, as they buy up more assets and expanding their balance sheet? What does that do to the asset prices? It pushes asset prices up even higher, right? So you have these sort of dual cycles between assets, particularly the housing market in this episode leading up to the financial crisis, and cycles in banks' balance sheets, right? Where banks' balance sheets are expanding, housing prices are being driven up, right? So you have this upswing from this leverage cycle, right? And once it flips, right, the same types of dynamics work in reverse. You have this negative feedback loops that cause these contraction in big balance sheets, falling asset prices, which exacerbate which force further contractions in bank balance sheets and so forth. Okay. Just this idea of funding versus market liquidity is an important idea here as well, right? As banks need to face a liquidity shortfall, right? There's a distinction between their ability to raise funds, right, and the ability to sell assets. Both of these were a problem during the financial crisis. So we spent some time also thinking about how did the Federal Reserve respond to the financial crisis, okay, and why did they have to respond in that way, right? So we talked about two broad reasons why monetary policy, normal monetary policy, can become ineffective in a financial crisis, right? What were those two reasons?
Too much bond purchase? Too much bond, so the graph is too much on the right side.
The big balance sheet.
So that's okay. So that forces some changes in how we do monetary policy going forward when we have a big balance sheet, right? Let's just think about normal monetary policy, right? So the Federal Reserve tries to stimulate the economy all right, by lowering interest rates. Okay. What are sort of the two big reasons why that doesn't work the way it should when we're in the middle of a financial crisis? Okay, so we think about our model, right? When we have a credit spread. So we have the saving rate and the borrowing rate. Okay. So the Federal Reserve sets the saving rate, and it's the borrowing rate that matters for the economy. Right? So in terms of this model, like when there's a financial crisis, what's happening to the spread? The spread gets larger, right? So even though the Federal Reserve lowers the short-term interest rate, it may not have a stimulatory impact on the economy because the financial market is disrupted, right? In our three-equation model, we can see that with the rise in the spread, right? So the Federal Reserve tries to lower the short-term interest rate, but if the spread is rising at the same time, right, that's not going to help, right? Because the borrowing rate that matters is still going to stay the same if the spread widens at the same time that the Fed lowers interest rates. Does that make sense? Okay. So in more general intuitive terms, right, if the financial market and if the financial system is disrupted to the point that it's not doing its job of channeling funds from savers to investors properly, right, then it doesn't matter what the Federal Reserve does to the interest rate, right? It's not going to help the economy just by lowering interest rates. Okay. So one thing is that we have to fix the financial system, right, before we can have a positive impact on the economy, right? What's the other problem in a financial crisis? And it's not necessarily limited to a financial crisis. What's the other sort of limit on the Federal Reserve's ability to stimulate the economy? The zero lower bound, right? They may hit a point where they can't lower interest. They can only lower interest rates to zero, and then they're stuck, and they may not be able to lower interest rates enough to adequately stimulate the economy, right? So, so just lowering the interest rate to zero. Once they lower the interest rate to zero, right? That's normal monetary policy. They hit their limit. They can't do anything else, right? So they have sort of these dual problems. That one, they can't lower the interest rate any further, and the financial system's messed up enough right now that it almost doesn't matter anyway, right? So number one, we need to try to stabilize the financial system, and then number two, try to find ways to stimulate the economy, further stimulate the economy, even though our short-term interest rate is already at zero, right? So what did the Federal Reserve do to try to fix the financial system as an immediate response? What did we talk about? What's that? So that's the government that's the federal government does fiscal policy from the Federal Reserve's perspective, right? What sorts of programs did the Federal Reserve institute as immediate response to the crisis? So they have these various liquidity programs, right? Like the term auction facility we talked about, right? So the Federal Reserve always stands ready to lend to banks when they need it. Banks weren't taking advantage of that, so they introduced a different program, a variety of different programs for lending to banks, right? In ways that didn't carry the same stigma as normal discount lending, like the term auction facility, right? And they also created additional programs that extended credit or liquidity for other institutions that were not banks, that were important for the financial system. So they instituted a variety of liquidity programs that were relatively short-term, right? And these sort of were phased out pretty quickly once the financial system stabilized. So there's this immediate response, right? In terms of our model, we could think of this as what is the Federal Reserve going to do to try to get the spread to shrink, right? By helping resolve the liquidity problems in the financial system, right? And then once the financial system was stabilized, now the problem that the Federal Reserve was faced with is we're at our zero lower bound, right? We've hit our limits of how we can stimulate the economy through normal monetary policy. Well, what else can we do to try to stimulate the economy further? And what were those? What were the two main things we talked about there? So quantitative easing, which means what? Not selling bonds, buying bonds. Buying lots of bonds, and not just any bonds, right? There's also like, there's also sort of directed purchase of particular types of bonds, right? Specifically what? Mortgage-backed securities and long-term treasuries. And what were the goals of that quantitative easing program? Okay, so one goal is to prop up the prices of mortgage-backed securities to help halt this downward leverage spiral in the banking system. Okay, so that's sort of a short-term, a short-term goal, right? Once that stabilized, the Federal Reserve still continued buying bonds up until very recently, up until the last year or two. Okay. And why were they doing that? Why did they continue buying bonds even after the financial system was stabilized? So there's not necessarily this direct need to prop up the asset values of banks anymore. But what were they trying to accomplish by buying up a lot of long-term bonds and mortgage-backed securities? What are they doing to the yield curve? They're trying to push it down, right? So they brought the low end to zero, right? By buying longer-term bonds in massive quantities. They're trying to bring down the long end as well, right? Through quantitative easing. Right? So add additional stimulus to the economy by pushing the rest of the yield curve down once they got the short end of the yield curve to zero. What about forward guidance? What's the idea of forward guidance? What's that?
To guide consumers' expectations.
Yeah. So we've already hit zero, right? So we've hit the limits of what we can actually do, but how else can we influence the economy? Right? By sort of shaping the public's expectations about how long we're going to keep interest rates low. Right? By telling the economy we're going to keep the short-term interest rate low for a long time, what does that do to the long end of the yield curve? It helps keep it down and stimulate the economy, and helps sort of provide some additional certainty as people are making their decisions about spending and investing. Okay? If you can convince the public that we're going to keep interest rates low for a long time, right, as opposed to bringing them back up in the near future, right, that can change people's behavior in a way that helps stimulate the economy.
Does the interest on excess reserves fit in one of these three categories, or is that a separate?
That's sort of the last thing. We actually talked about these things in reverse order. Right? In the summary, I thought it made sense to maybe talk about this first. We had this crisis. This is how the Federal Reserve immediately responded to the crisis. As a result of these actions, the Federal Reserve now has a big balance sheet, right? And now, in the last little over a year, we finally reached the point where the Federal Reserve is ready to start raising interest rates from zero, but we have this massive balance sheet, right? So we can't do monetary policy in the traditional way anymore. What was the traditional way of meeting whatever the target federal funds rate was? Open market operations, to fine tune the supply of reserves in the economy, right? Now the supply of reserves is so massive that sort of fine tuning through open market operations isn't going to make a difference in the Fed funds rate anymore. So what does the Federal Reserve do now instead in order to raise interest rates? They can just raise the interest that they're paying on excess reserves. Right? And that sort of sets the baseline for interest rates in the banking system and the economy. Right? There's some discussion of various alternatives. I mean, there's other things that the Federal Reserve could do, right, to raise the federal funds rate, right? And the reading that I gave you sort of walked through all the different options, right, and talked about why is it that just changing the interest rate on excess reserves is the best option. And what's the gist of why it's the best option? So there are three main criteria that the reading talks about. One is, like, does it encourage sort of arbitrage and competition amongst the different sources of short-term funds for banks? right? Number two, like, is it expanding the Federal Reserve's influence into other short-term money markets, like in a direct way, right? And that's kind of a negative. The Federal Reserve doesn't want to be pushing around all the different money markets, all right, directly. Right? And the other thing is, does it restrict the supply of reserves? That's also viewed as a negative thing. Why is that negative? Why do we like the banks having lots of reserves? Keeps them safer, right? Right? It helps prevent liquidity, a future liquidity crisis. So the benefit of using the interest on excess reserves as a primary tool, right, is that it allows the Federal Reserve to raise interest rates in a way that doesn't unnecessarily expand their influence into other markets, and right doesn't involve actually selling off bonds and reducing the supply of reserves in the banking system. But the balance sheet is bigger than it needs to be, right? Right, and we're starting to think about normalizing the balance sheet in the sense of reducing the size and taking the lid off of longer term interest rates slowly and gradually, right? But it's likely that the Federal Reserve will maintain a bigger balance sheet than it used to going forward, and primarily conduct monetary policy through the interest on excess reserves rather than going back to open market operations.
Sorry, one of those points was this competition between the banks.
So competition or arbitrage amongst different, so between repo markets versus commercial paper markets versus the market for reserves like the Fed funds market, right? Those are all different sources in which a bank can borrow and raise short-term funding, right? So we've talked a lot about why the interest rates in those markets are going to be relatively similar to each other, right? And the Federal Reserve could potentially influence the economy by adjusting any of those, by messing with any of those markets, right? But they don't want to expand across their influence across all those markets unnecessarily. So they want to restrict their influence to the federal funds market, right? And then let the other markets just kind of follow. That's the idea. All right, you guys get this? You guys have this written out?
Just when you're done. If you could, we have it at 11, so
Okay.
just,
Okay, we'll wrap up.
awesome, thank you.
All right. Okay. So we won't have time to go through this other stuff in detail, but it's fairly recent stuff that should be fresh on your minds, right? So exchange rates, right? Make sure you understand the difference between nominal and real exchange rates, right? When there's a change in the nominal exchange rate, that's going to reflect some combination of a change in the real exchange rate and the difference in inflation rates between the two economies, right? This idea of purchasing power parity, right? What's the argument for why there should be purchasing power parity, and what does that mean? That the nominal exchange rate or the real exchange rate should always be basically 1, right? So all changes should be coming from differences in inflation, right? But that might not hold for a variety of reasons that we talked about. This idea of interest rate parity, the big picture idea here is that, right, arbitrage is going to force, once you adjust for the exchange rate, interest rates should be roughly the same across countries, right? So changes in exchange rates over time should reflect any differences in interest rates across the countries, right? And then finally, we built that into the 3-equation model of the open economy. The big insight here is that net exports has to equal net capital flows, right? Which comes from savings minus investment, right? And so changes in the domestic economy and changes in the interest rates are going to flow through to changes in net capital flows, and then exchange rates are going to have to fluctuate in order for net exports to equal net capital flows. Right? So, good luck on the exam. If you need help with any particular concept, talk to the TAs or myself, and we'll be glad to help you out. And best of luck to you.